This is the idiot's guide to trading divergences. Now, most professionals say, don't try to catch the tops and bottoms. It's a fool's game. You'll get slaughtered. Stick with the trend. It's your friend. Well, I say, if you're only stuck to trading just trends, you'll be missing out on 70% of the potential action out there. And that's right, 70% of the time, price is meandering about, stalling or consolidating and creating flags and pennants and heads and shoulders and other chart patterns. And the remainder of the time, price is on the move, trying to find another place to stall and hang out for a while. So if you have a system in your toolbox that you can provide more opportunities, a leading indicator, then why not use it? That's where divergences come in. Divergences are a reliable way to spot markets that are out of whack, where price and market strength become dislocated. And what stems from these dislocations is the urgent need to get back into whack. But divergences are not only for spotting tops and bottoms, or pivot points as some traders call them, they're also an effective way to confirm that a trend will continue. And that's where we get into this nuance of divergences. Nuances that require absolute clarity, because if you're not completely familiar with the types of divergences and their effect, then you might be thinking you're going to profit when in fact you're about to prove what a loser you really are. So I'm here to help you out and teach you how to differentiate between the two types of divergence out there, and they are regular and hidden. So let's start by saying that spotting divergences at the most basic level is done by comparing price pivot points with corresponding pivot points on an oscillator, like the RSI, stochastic, or MACD. Now you take your pick which oscillator you want to use and stick with it. I'm going to show you divergences using the RSI. So let's start off by identifying the types of divergences and how to spot them. There are two types of divergences, and each type has both a bearish and bullish subtype. And as I said before, the two types are regular and hidden. Now, most traders have been introduced to regular divergences only, probably because whoever told them only knew half the story. And so, armed with half the story, they go out and try to apply their ignorance to a trade and consequently lose all their money. And of course, they blame it on the inconsistency of divergences because it couldn't possibly be that they're wrong. So let's start by being very clear on identifying the divergence type and whether it's bearish or bullish. And furthermore, whether it is forecasting a change in trend or confirming the continuation of an existing trend. So start by thinking higher highs and lower lows. If price is making higher highs, then your oscillator should also be making higher highs. And likewise, if price is making lower lows, then so should your oscillator. If your oscillator isn't jiving with price action, then you probably have a divergence. A divergence is signaling the weakening of a trend or change in momentum. Sometimes it confirms that the trend will continue. So let's start with regular divergences. There's the bullish type that you can spot when price is showing lower lows, while the oscillator is sporting higher lows. This is a sign that bears are getting exhausted and strength is building, and if this divergence reaches a breaking point, then the downtrend will change to an uptrend. All right, now let's look at the bearish type of regular divergence. That's where price is showing higher highs, but your oscillator is diverging, showing lower highs. Now this is an indication that underlying weakness is forming, warning you that an uptrend is about to change to a downtrend. All right, now we're going to get on to the nuanced, the hidden divergence. All right, now let's get on to this. This is a much less known variety of divergence. It's typically used to confirm existing superior trends. Now, I've seen so many online analysts get it wrong, calling for a reversal in a trend based on what they think is a regular divergence, when in fact it's a hidden divergence. I mean, they don't know their divergence from their ass. These online technical analysts are the bane to traders seeking knowledge. They spew bullshit onto ignorant traders like yourself. So you've got to be armed with superior knowledge and fight their evil ways. I can't stop you from listening to them, and I'm not going to publish a list of good versus bad YouTubers. So do your homework, do your due diligence. All right, so on to the bullish version of hidden divergences. This is where price is sporting a higher low while the oscillator is making a lower low. Now, at first glance, this might look like a bearish regular divergence, but the difference is the position of the oscillator. It's oversold, not overbought. What you're seeing is the underlying strength of the current trend resuming and building. This often occurs during retracements in an uptrend. This is the confirmation you need in that off-cited trade advice, buy the dip. And now the complement to the bullish hidden divergence, and that's the bearish hidden divergence. And this is where price is trending down and then pulls back and shows a lower high, while the oscillator is making a higher high. Now the oscillator is showing overbought, and this pullback is about to give way to the existing downtrend. This is confirmation to selling the rallies in a bearish market. So to wrap it up, there are two types of divergences, regular and hidden, and they're bullish and bearish subtypes. Now, I know that this is a lot to digest, and it may be a while before you can differentiate between regular and hidden divergences without some sort of aid. So in the meantime, I suggest you create a cheat sheet. How do you trade these divergences? What are the specific setups? How do you determine the entry and exit? How do you manage the trade? These are all great questions that I'll answer in future videos. See you next video.